Hello, so today we're going to be looking at minimum prices. So minimum prices are a form of government intervention. So all that basically means is the government is coming into a market, distorting price signals, changing things, and they will do that to correct market failure. We'll have a look at what potential market failures they might be correcting through a minimum price in just a moment. So minimum prices essentially manipulate price signals. Now there are lots of government intervention that manipulate price signals. They tend to be ones that directly affect the price within the market, taxes, subsidies, minimum prices, maximum prices, all of those distort price signals. Not all government intervention distorts price signals. So be very careful when you are using that kind of term in your exam, because not all government intervention distorts price signals in the market. So what minimum prices do is they essentially set a floor. It is just what it's called, it's a minimum price. So you cannot set below the minimum price. So a firm can't come in and be like, we want to set the price below the minimum price that the government has set in the market. They're not allowed to do that. They can set the price higher than the minimum price, but they definitely can't set it lower than the minimum price. So if they want to set it above, absolutely fine, below, not allowed. So it is essentially you can think of it as like a law in the market. It's a regulation that kind of means that, if a firm is breaking it, then they are susceptible to the same kind of repercussions than they would be if they broke any other competition rules in the market, right? So it is enforceable minimum price. So it's not just a suggested, it is enforceable. So what I want you to think about is, where do we set our minimum price, or where does the government set its minimum price, and why? So to think about this, we just need to think about what is the impact, why are they intervening into the market? So we know that a lot of the time the government intervenes to correct market failure, and that can be different types of market failure in the market. It may well be missing markets, it might be externalities, it might be an under or over provision of goods or services. Those are the reasons why the government will intervene. And a minimum price is no other, there is no exception to that. The government is intervening to correct a market failure. So that may well be, and what might be useful for you is to think about what type of industries they may well be setting a minimum price in. So, or what minimum prices you maybe know about already. So let's think about what would happen if they set the minimum price below the market equilibrium. So if you set a minimum price below the market equilibrium, well, what would happen? Remember what I said about what a minimum price actually is. So a minimum price just means that you cannot set the price below that market price that is set as the minimum price. So if we set the minimum price here, what would happen? Well, at that minimum price, we would have excess demand. What happens when you have excess demand? Prices rise and you would be at the market equilibrium already. Well, okay, then let's now think about why a government might introduce a minimum price. Well, we've seen minimum prices being kind of battered around and talked about in alcohol. Well, why would the government be intervening in the market for alcohol? Well, we know that that's to correct market failure. What market failure? It's the externality. So you want to reduce private consumption, right? You want to reduce the amount consumed in the market. Well, therefore you want to reduce demand. And let's think of another minimum price that we know, the minimum wage. We all know about the minimum wage. We know that you can't be charged less than the minimum wage for working whatever age band you are in. Well, in that case, the minimum wage was introduced to be able to increase supply. So if you are saying that at the market equilibrium you either have too much demand or not enough supply, well, at that point you know that your minimum wage should be set above the market price, because then we're just looking at how we can manipulate price mechanisms, manipulate price signals in order to increase supply or to decrease demand. So if we set our minimum price above the market equilibrium, then we can see that that is exactly what's happening in the market. We are either decreasing demand at the minimum price, or we are increasing our supply at the minimum price. And that's exactly what the government is aiming to do with a minimum price. Now, how you are going to explain this in your exam is completely up to you, but you definitely want to be looking at why the government is intervening. So our connective theory that we might be using, if we're talking about a decrease in demand, obviously you're going to be talking about externalities. You want to decrease the externality in the market, say for instance minimum price on alcohol, and therefore you want to increase the marginal private cost, which then will decrease the negative externality. Now, if the government is introducing a minimum price to increase supply, so we know that that's what's happened with the minimum wage, but there's also been calls to introduce a minimum price for farmers that are at the hands of monopsonies. So one of the potential solutions that they have been saying is for them to introduce a minimum price. Now that is obviously to protect supply, because we know that monopsonies will often, if they choose to abuse their monopsony power, offer below the market price. So in that case, the minimum price may well be just above the market price in order for firms to make some small amount of supernormal profit, to reinvest and become dynamically efficient, etc., etc. So when you're talking about this in your exam, you need to be very, very careful as to why the minimum price has been introduced. Is it to increase supply, or is it to decrease demand? So just to kind of sum up that last point here, if the minimum price is set below the price equilibrium, normal market mechanisms will render it irrelevant. Normal market mechanisms will literally just set the price naturally above the minimum price in the first place because of the existence of excess demand. Because you have excess demand, if the minimum price is below the market equilibrium, then the normal market mechanisms will just push that price up to clear the market of the excess demand, and therefore the minimum price will be rendered useless. Now that is not to say that you don't see that happening in the market. So for instance, the minimum price for labour, when you talk about kind of like the equilibrium point, it's set above the equilibrium, but it's only set above the equilibrium for some industries, right? So the wage would be lower in some industries, but if you think about most industries, most people in the economy do not earn the minimum wage. So actually, if you think about a teacher, for instance, if there's an increase in the minimum wage, though I am exceptionally happy for everybody else in the economy that is earning the minimum wage, it doesn't have an impact on my wage, because my equilibrium wage level is above the market, is above the minimum wage minimum price, right? So therefore, the increase in the minimum wage for me as a teacher is irrelevant. It doesn't affect my wage. So if the minimum wage or the minimum price is below the market equilibrium, then it becomes kind of useless. So it is irrelevant in the market. But we know that actually when it comes to into any government intervention, there are always going to be positives, there are always going to be negatives. Whenever you mess around with market equilibriums, whenever you mess around with market mechanisms, it can get messy, it can not have your desired effect, you might experience government failure, but also it's just going to mess the market up. It's not working the way that it should work. So one of the downsides, however, of intervening into any market artificially, because that's exactly what's happening here, you've got artificial market mechanisms, you're artificially changing your market equilibrium, you're messing around with normal market mechanisms, and you're always going to have kind of some negative impacts or potential things that can happen in the market that are undesirable. And that is no different here at minimum prices. So whilst you might successfully decrease demand from the introduction of a minimum price, that doesn't necessarily mean that you're not going to create excess supply, and you're going to encourage the price signal that you are creating will also affect supply as well as demand. It will affect both of them. Both sides react to price signals in the market, right? So therefore, if you are signaling a price rise artificially, you're entering the market, you're artificially signaling a price rise, what that means is that you are signaling a decrease in demand, fantastic if that's what you're aiming to do, minimum price on alcohol, but what you also might be signaling to suppliers is to increase supply, right? So you might be signalling for suppliers to enter the market because the price has risen. So what you might end up with is excess supply. So one of our possible evaluation points is you might decrease demand for alcohol if you were asked about minimum price on alcohol. However, you might also increase supply. And equally with the minimum wage, we know that whilst you're increasing supply potentially, actually that might have the adverse effect in decreased demand, and then all you're doing is you're creating excess supply. Excess supply, which under normal market mechanisms would be cleared by a decrease in price. However, we know that price cannot decrease under a minimum wage, and therefore the excess supply is just going to exist in the market. Now that might clear naturally because often governments tend to not just do one type of government intervention, they might do several types of government intervention at once. So for instance, and also, you know, with the minimum wage, it's a classic argument that people are going to demand less, firms are going to demand less labour, but actually that isn't true. We haven't seen that in the market. We've seen lots of demand for labour in the market, despite often because labour is a derived demand, and therefore if you've got more income coming in, then you're more likely to spend that and have your multiplier effect, etc., etc., and therefore your firms are more likely to want to employ more labour. So actually governments intervene not just with one type of government intervention, so often you too tend to find that they might try and kind of artificially boost demand as well to get rid of some excess supply, or encourage firms to reduce their supply as well, because they know that they're not going to be able to clear that excess supply, so they're actually encouraged to shift supply inwards because they've got stock that they can't sell, etc. And also we can balance this out by talking about elasticity as well. Obviously, if you have an incredibly inelastic demand, then the change in price is not really going to affect your demand, so it's not going to create as much excess supply as you may think. If you've got both an inelastic demand and an inelastic supply, the idea of a minimum price being introduced in the market may not have that much effect creating excess supply, and it might just mean the suppliers are better off in the market, or those who are demanding doesn't really affect their kind of demand for that product or service. So if you are AS level, or if you just want the very bare minimum, then you can kind of stop watching now, look at you, but the rest of you, we are going to talk about price setting power in the market and a minimum price. So what does it mean? We know that we are having some assumptions when we look at that price equilibrium, that kind of industry diagram there, and one of the assumptions we're making is that firms are charging the market equilibrium price, and we know that if they have a downward AR or MR sloping curve, then they absolutely have some form of price setting power. And quite often, if you think about like alcohol, if you think about, even though they are contestable industries, they do have oligopolies that have some decent amount of price setting power. So more often than not, we should be working with this diagram here, where we have the market equilibrium price, but then we also have the actual market price, which is the price that is set, kind of the average price in the market when you look at the existence of price setting power. So, because we know that firms are making supernormal profit. So where do we set the minimum price in this case? Well, in this case, we still know that the minimum price can be very effective in slowing down supply and decreasing demand. But if you are going to do that, then you have to set the minimum price above the market price with price setting power. If you set the minimum price here, then firms would still charge this price here, and even though it's above the market equilibrium, the kind of market equilibrium price, it's definitely not above the market price, which means that firms will just charge above it, which in that case is then rendering the minimum price useless, the same as it was before. So if you're going to set a minimum price in the market, and you have a market that is has price setting power in it, you want to make sure that you are setting a minimum price that is effective even under those conditions, in which case you want to make sure that your minimum price is above your market price, which is obviously, if you have price setting power for firms, they're going to be above your market equilibrium price, because in that case you are still having the effect of decreasing quantity demanded. It's not as much as if you were under perfect competition, but it is definitely still having an impact in the market. If you are hoping to decrease demand, obviously this is the diagram for if you're aiming, the government intervention is aiming to decrease demand. This is not to influence supply, though you can have a look at, try and kind of have a go at increasing, if there's a price setting power and you want to increase supply, often actually that price setting, the market price is actually below the equilibrium. If you're confused by that, just think about monopsonies. If there's a monopsony in the market, then, and this is just kind of referencing the idea of introducing a minimum price for farmers who are kind of being abused by monopsony power. In that case, the market price is actually often below the equilibrium price. We know that monopsonies will set the price to their farmers below the equilibrium price because they are the ones who have the price setting power in the market. But in this case here, you have to set it above the market equilibrium price for it to be effective in the market. So it'll still be effective, it's still increasing the cost, so your marginal private cost will still rise and the externality will still fall because you're above the market price. Now, you might be confused and think about that actually firms will make more profit under this, but we know that that's not actually true. If we make just the assumption that this market price is going to be the firm's profit maximising price, so let's just kind of assume that these two are going to be the same, well then we know that any price above this is going to be where our MC is actually lower than our MR. If our MC is lower than our MR, then the firm can gain more profit by providing an additional unit to the market. So actually, if you set the price above this profit maximizing price, so say for instance this is the minimum price, then actually we're going to see a fall in supernormal profits. Now, even though that might be difficult to see on the diagram, the theory absolutely still holds true, because if you're charging a price where your, it's probably better if I drew this a little bit better, where your marginal cost is below your marginal revenue, then you know that you should be providing an additional unit to the market because your profit growth can be higher. That's just kind of standard profit maximising position theory, so if you're confused by that, have a look at your profit maximising theory. So all of this is telling us here essentially is that if the price is above the market price that's set by firms anyway, then we know that we can make an assumption that actually that means that that price is above their profit maximising price. Now, if it's above their profit maximising price, then we know that their marginal revenue is higher than their marginal cost, and that they should lower the price and sell an additional unit because they should make an additional unit because their profit growth will be higher if they do that. So actually where this minimum price is, firms will be making less profit because of the amount demanded. So if you have any questions, please let me know and I'll be able to answer them for you. I hope that you've understood this lesson, and I'm really looking forward to doing some more government intervention with you soon. Bye!